Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We are from Group 4 and today we will be explaining about static and flexible budget. So here, this is our group members. Without further ado, let's move on to our first agenda, which is the definition of static and flexible budget. So first agenda, I'll be explaining the definition and the difference between static budget and flexible budget. But before we go further, let's take a look at the simple definition of budget. So what is actually budget? Budget is actually a company spending towards their sales, spending, and how much profit that they are expected to be. That they are expected to earn. So what is the difference between static budget and a flexible budget? Static budget is only focused on forecasted sales, which means what is what the company is planned to achieve. Meanwhile, for flexible budget, it is based on their level of actual activity. At the end of this slide, Mr. Kisti will be explaining about numerical example towards this budget. But for now, let's just focus on the basic concept. I'll give you one of the example. Let's just assume that a static budget mentioned that 1,000 units of product are being sold, but the actual result is only 900 units of product. Comparing these two numbers, which is 1,000 and 900, making it unfair because the number of units sold isn't same. Yeah. So for flexible budget, the comparison is done using the same number of units sold, making it more accurate and fair, especially when it comes to measuring performance. I'll pass to the next presenter.
So for my part, I will tell you guys about why flexible budget is better performance for evaluation. So for the static budget, so a static budget is prepared before the period begins. So it based on an expected level of activity. So when it's made, it doesn't change even if the actual condition are different. So the static budget are very good for the planning, but not for measuring a real performance. This is because of they may be give a misleading variance. So the next one is flexible budget. So a flexible budget solves the problem by adjusting to actual activity levels. For example, if only 90% of your target sales happen, the flexible budget will recalculate your expected expenses based on the 90%. So it usually prepare during or after the period and help compare actual performance and make a realistic target.
Now I will explain how a flexible budget is better for performance evaluation. Okay, I will go through for the first one is it adjusts to actual sale or production, making it easier to see if differences were due to performance or volume. So if your company sold more or less than expected or produced more or fewer units, the budget will also change to match that. This makes it easier to identify whether differences in budget and actual result was caused by a staff performance or just the change in volume. For the second one is it highlights true variances, not just changes in sale volume. This means we are not just looking at how much we sold, but also looking into other differences. For example, like higher material cost or maybe lower productivity. This will help us to understand what's really caused the result. So instead of making a guess, manager can see clearly where the things went well and where they did not. So the third one is help managers make fair decision based on real outcome and not real unrealistic target. Okay, with this flexible budget, managers can make decision based on real number and real situation. This lead to more accurate evaluation and better planning for the future. For the last one is it prevents blaming staff for performance issue caused by external change. This means it helps avoid blaming staff when problem happen due to the things that they cannot control. For example, like sudden price increase, changes in the market, or supply chain issues. Okay. When we use a flexible budget, we can see that the issue was not the worker or the team, but sometimes outside their control. This help protect morale and support better teamwork in the long run.
For this slide now, I'm going to explain some important technical issue that we call it a quantitative issue in flexible budgeting. First point, cost classification. We have variable cost and fixed cost. Variable cost may depend on how much we produce on the production, and fixed cost is not depends on production, such as rent and salary. When we wrongly mix up for two variable cost and fixed cost, it may give me the wrong calculation of budget. For the second point, accurate cost behavior formula. We use formula Y equal to A plus BX. Y will be total cost, A will be fixed cost, and BX is more to the variable cost in our activity. And when we use the wrong number in the formula, we will get the wrong outcome for the whole budget in the flexible budgeting.
For point number 3, activity level sensitivity. Flexible budget change with actual unit sold produce. This means that flexible budget is more accurate in cost control and analysis because it's based on a real performance. But point number 2, small error in actual activity can lead to a less variance. This means slight mistake can make a big difference in a real performance.
Timing of cost. Some costs evenly not happen for the every month, like annual insurance, and also for the machines maintenance for the every 3 months. We need to get the real timing of the cost to get the good whole budget for flexible budgeting.
For last point, data reliability, must use update and accurate data. Poor data mean misleading result and wrong decision. This means using outdated, incorrect, or inconsistent data can lead to wrong decision analysis. This may cause a poor decision as the data does not reflect the true situation.
Okay, next we're gonna look on the effect on decision making. We're gonna look on how actually the quantitative issues affect on a decision making in flexible budgeting. So the first one is bad data leads to unfair or inaccurate conclusion. So basically, flexible budget can adjust your expected sales and also your revenues based on the actual level of activities that occur. So the consequences is if the cost if a cost is miscalculated or misclassified, it can lead to the an inefficient in budgeting. So basically, the data we receive is inaccurate, so therefore leads to inaccurate conclusions. Okay, next point is on poor cost control decisions. So as we know, flexible budgets is based on the actual level of activity. So whatever the cost that incurred in the period, so it related to the actual level of activity in the flexible budgeting. So if the cost is miscalculated or misstated in the budget, it really gives impact to the flexible budgeting and therefore leads to the poor cost control decisions.
So the next one is ineffective resources allocation. So what it means, if your flexible budget is based on inaccurate activity levels or faulty cost data, the business may allocate too many or too few resources like labor, material, or equipment, and it's to different department or project. And it's leading over-ordering of raw materials, which is wasted inventory, overstaffing, and high cost with no matching revenue. And it gives impact on decision making, which is managers may think demand is strong and continue, and overspending, which is was adjust product capacity based on fast projection. Okay, for the last one is unreliable variance analysis. So what it means? It means that flexible budget are used to calculate variance, like spending variance, which is how much you spend versus what you should have spent at actual activity, and efficiency variance. But if your flexible budget use wrong variable cost rate, incorrect output data, or poor cost classification, it will lead to the variance become misleading. Okay, so to be conclude, these are 4 main point on decision making, which is bad data leads to unfair or inaccurate conclusion, poor cost control decision, ineffective resources allocation, and unreliable variance analysis.
So last but not least, we're going to look on the numerical example on static budget versus flexible budgets. So as was mentioned by Haziq earlier on the definition of the static budget and flexible budget. So now we're going to look more deeper, or we're going to look into more details on the example here. So given here, assume forecasted sales is 1,000 units, where actual sales is actually 900 units, which is that is 90% of the forecasted sales. So the selling price is 100, which is same throughout the year, and also variable cost per unit is 50, and fixed cost is 20,000. So notice that there are several columns here. So to start with, actual result, and followed by revenue and spending variance, and flexible budget, and also activity variance, and also static budget. So what actually revenue and spending variance? So basically, revenue variance is the difference between the actual result and also the result that should have been. So whereas the spending variance means the difference between this, the cost, the actual cost, and also the what cost should have been. And for the activity variances, it will be focuses on flexible budget and also the static budget, where activity variance is the difference between the actual activity level versus the planned activity level, that was stated in the static budget. So let's look at the revenue and spending variance first. So notice that for the sales revenue, we have 2,000 unfavorable. So basically, the actual result will subtracted from the flexible budget, so we get 2,000 unfavorable. This is unfavorable because the actual result is less than flexible budget. So moving on, we have variable cost 44,000 and also 1,000. The difference is 1,000 as compared to the flexible budget, which is 45,000. So notice here the 1,000 is favorable because the actual cost is less than the flexible budget. So next we have fixed cost, which is the same. And here the lastly is, so we're gonna look the net operating income here is significant. So 24,000 for the actual result or actual revenue that we gotten, actual net operating income that we gotten for the period, and also the flexible budget is 25,000. So we get the variance here is 1,000 unfavorable. This is unfavorable because the actual revenue we've got is less than the flexible budget. So next we're gonna look on the activity variances, which will be focused on the difference between flexible budget and also the static budget. So the first one is sales revenue. Notice on the flexible budget we've got 90,000, and for the planning budget or static budget we got 1,000. So why actually is different? Because flexible budget is focused on the actual sales, whereas the static budget is based on the assumed forecasted sale, which is 1,000, and then 100, which is different in the amount. So the activity variance is different, 10,000 unfavorable, because the actual level of activity is less than the planned activity by 10,000. So that is why it is unfavorable. So next, variable cost, which we have for the flexible budget is 45,000, which is based on the actual unit, which is 900. And the static budget, and from the static budget, we've got 50,000, and the activity variances is 5,000 and favorable. This is favorable because the actual activity that happened in the period is less than the planned activity that was stated in the static budget. Okay, for net operating income, so flexible budget is 25,000 and the static budget is 30,000. So activity variance is 5,000 unfavorable. This is because less sales was generated as compared to the for the planning budget. So actually why it different between actual result and also the flexible budget? For example, for the sales revenue, actual result is 88,000 and the flexible budget is 90,000. So it may be because we are giving discount to the customer, so there is one possible reason. And also we're gonna look on the for the variable cost here. So actual result is 45,000 that we incurred, and then on the flexible budget is 45,000. So it's differ because maybe we are paying less than the actual input. So to conclude, these are differences between static budget and also the flexible budgets. So thank you.